What if the next major safe haven currency isn't the US dollar, or the Japanese yen, or even the Swiss franc? It might just be one you've never considered, the Singapore dollar. Here's the twist. While the world fixates on traditional currencies to weather financial storms, a quiet shift is happening in Asia. In Singapore, with its disciplined economic model and ironclad monetary structure, might be positioning its currency as the Swiss franc of the East. Do you think the Singapore dollar will rise to global safe haven status? Yes or no? Let us know in the comments. We want to hear your thoughts. In today's episode of Enoch Report, we're diving deep into the evolution of the Singapore dollar, exploring how this small city-state's currency is gaining credibility across global markets, and more importantly, whether it could one day rival the tried and tested havens of Europe or America. We'll look at the forces fueling this transformation, the underlying risks, and why this matters not just for Asia-Pacific, but for anyone seeking portfolio protection in uncertain markets. Because what's uncovered by the end of this story could fundamentally change how we think about safety in global finance. So stay with us. This one could shift your entire currency strategy. Traditionally, when markets tremble, whether from war, inflation, or a global downturn, investors rush towards safe haven assets. You know the usual suspects: gold, U.S. treasuries, and time-honored currencies like the Japanese yen, US dollar, or Swiss franc. These assets promise stability, especially when everything else seems to be unraveling. But is that playbook still working? The US dollar, the ultimate reserve currency, is showing cracks. Its dominance remains unmatched in sheer volume, yet its index has stumbled, falling more than 9% this year. Mounting fiscal deficits, political gridlock, and a growing threat from de-dollarization movements are all contributors to this decline. Meanwhile, the Japanese yen, once a darling during periods of Asian turmoil, is being pressured by prolonged trade disputes and decades-long structural economic issues. Even the Swiss franc, long heralded as the global benchmark for monetary discipline, now faces increased scrutiny as interest rates swing and inflation creeps back into the Eurozone. Global uncertainty is mounting, but trust in traditional safe havens isn't growing with it. In the midst of this instability, one currency is rising, almost unnoticed: the Singapore dollar. We've seen this trend take shape quietly, but analysts are now talking openly about it. Christopher Wong, FX strategist at OCBC Bank, describes the Singapore dollar, or SGD, as a quasi-safe haven in Asia and among emerging markets. It doesn't carry the global recognition of a Swiss franc or the market heft of the US dollar, but during periods of regional or global tension, it's shown impressive resilience. In fact, the Singapore dollar has appreciated roughly 6% against the US dollar so far this year. Investment bank Jefferies has even forecasted that the SGD may reach parity with the US dollar within 5 years. So what's driving this quiet yet powerful ascent? According to Omar Slim of PineBridge Investments, the foundation of the Singapore dollar's growing reputation lies not in hype, but in its structure. Singapore is built on institutional strength, economic resilience, and a culture of fiscal prudence. It doesn't just look stable, it is stable. Felix Brill, Chief Investment Officer at VP Bank, further highlights that the Singapore dollar checks nearly every box we associate with a modern, safe haven currency: a sustainable and predictable macroeconomic environment, robust governing institutions, a large current account surplus, extremely low political risk. These are more than just metrics. They translate into real investor trust. And in volatile times, trust is everything. Currencies, however, don't float on sentiment alone. To understand the strength of the Singapore dollar, we must look at the real economic forces behind it. First up, Singapore's financial sector. It's no secret that the city-state is a major financial services hub in Southeast Asia. It hosts an enormous volume of cross-border investment and wealth management activity. This alone drives consistent demand for the SGD. Next, shipping and logistics. Singapore's port ranks among the busiest global transshipment hubs, linking Asia, Europe, and the Americas. Nearly every vessel docked, there is a source of SGD-denominated economic activity, another underappreciated engine generating stable currency flows. Lastly, Singapore's role in high-tech manufacturing and biomedical sectors cannot be overstated. from semiconductor manufacturing to pharmaceutical R&D. These high-value, export-heavy industries contribute significantly to foreign exchange earnings, and they do so with relatively low volatility. Put simply, Singapore isn't just riding market perception, it has the economic infrastructure to back the rise of its dollar. Even more fascinating is Singapore's unconventional approach to managing its own currency. Unlike most countries that rely primarily on tweaking interest rates, Singapore operates on an exchange rate-based monetary policy. The Monetary Authority of Singapore (MAS) manages the SGD against a basket of major trading partner currencies within a secretive but closely regulated policy band. This targeted approach dampens volatility. Jeff Ng from Sumitomo Mitsui estimates the band's width at approximately 4%, giving investors more short-term predictability in a region that often sees currency turbulence. Brill is explicit. This system brings extraordinary stability, which is exactly what seekers of safe haven assets are searching for. Predictable, cautious, disciplined. This is the monetary architecture that supports the SGD's slow march towards legitimacy. If you've made it this far, you're not here for surface-level hype. You're digging into the real stuff. And that's what sets Enoch Report apart. So if you're serious about global finance and strategic thinking, make sure to subscribe and turn on the bell, because we're not just studying trends. We're watching the forces that shape portfolios and rewire financial futures. Here's something easy to underestimate: the silent force of psychological trust in markets. Over years of regional tensions, whether in East Asia, the Middle East, or parts of Europe, we've seen capital quietly reroute into Singapore. That's not just about policy, it's about perception. Investors believe their money is safe there. And that belief, over time, reinforces the currency's reliability. Combine Singapore's high liquidity, international accessibility, and a long history of calm economic stewardship, you get a currency that markets treat as a default defensive move, even if it's not wearing the badge yet. Despite all this, the Singapore dollar still has hurdles to clear before it can wear the crown of global safe haven. First, its size. According to the most recent Bank for International Settlements data, USD dominates 88% of foreign exchange turnovers. The yen controls 17%, the euro 31%, and the franc still holds 5%, the SGD just 2%. Then, there's the double-edged sword of controlled monetary policy. Yes, it makes the currency stable, but it also limits liquidity and depth. Investors seeking large-scale hedging options may find it too constrained. Brill puts it plainly: stable, yes; scalable, not yet. One structural limitation: Singapore's export-driven model. In 2024, exports accounted for a staggering 178.8% of its GDP, per World Bank data. That kind of overexposure means the MAS can't afford a runaway spike in the SGD's value. Trin Nguyen at Natixis warns that if SGD appreciates too much, is a flood of investors rush into so-called safe, holding Singapore's export competitiveness could suffer. In short, Singapore needs a strong, yet not too strong currency. That's a delicate balance, not easy to manage, as demand for the SGD continues to quietly climb. So maybe the goal for the Singapore dollar isn't to destroy the franc or the yen. Maybe it's to become the third currency in a diversified portfolio, a reliable co-pilot rather than a solo flyer. Jean Chia from Bank of Singapore supports this idea. She sees the SGD becoming an increasingly important diversification tool, especially in Asia-focused portfolios looking to hedge currency risks without exposure to volatile emerging markets or politically risky giants. This brings us to a crucial question: can the Singapore dollar match, or even replace, the Swiss franc as the preferred safe haven benchmark for the modern age? Felix Brill is cautiously optimistic. He says status isn't built overnight, but over decades of crisis-tested performance. The SGD has held fast during Asia-specific downturns, but is yet to be validated in a truly global economic meltdown. That may change. As traditional havens become less reliable or politically complicated, currencies like the SGD will continue rising in relevance simply by doing what they've always done: staying calm amid storms. Omar Slim shares this optimism, declaring the SGD is increasingly top of mind. For global investors, Not because it mimics the dollar or yen, but because it offers something rarer: consistency and clarity. Janaea Chua from Julius Baer pushes it even further. A global safe haven isn't out of reach. It's just a matter of time, experience, and continued smart governance. So now, it's your turn. Is the Singapore dollar really on its way to becoming the next Swiss franc? Or is the hype getting ahead of reality? Let us know. Do you believe the Singapore dollar could become a global safe haven currency? Yes or no? Drop your view in the comments. We read every single one. If today's deep dive challenged the way you think about global currencies and long-term investment strategy, don't just like the video. Subscribe to Enoch Report. Hit that bell icon. Because in a world where markets move on perception, timing, and trust, clarity is currency. And that's what we bring. Till next time, stay informed, stay ahead.